Good afternoon. My name is Mike Lawson. I'm the Senior Associate Dean of the School of Management, and I'll act as the moderator for today's panel discussion. We met in this auditorium in September 29th to be exact, when the Dow was at 11,200. That was an interesting day. The Dow closed down 777 points that day, and as you might remember, that was also the day that the Congress initially rejected the President's proposal for a remedy to our financial crisis. Later, of course, they did appropriate almost $700 billion for what was called the TARP. Today, as I came down here with my colleagues, the Dow was trading at about 7,500. We also met a few weeks ago with some of my colleagues. Professor Smith is in the audience, and he was one, where we again tried to make sense of what was happening. And that panel discussion will be posted on the School of Management's website by the end of this week. So this is really our third attempt to try to make sense of what's going on. This time, though, we're focused not on the TARP, the Troubled Asset Recovery Program as it was called, which was meant to stabilize the imploding financial sector, but I think the sector is still at least not stable, if not imploding. We had a historic election in November and inaugurated the country's 44th president on January 20th. Tomorrow, President Obama will have been in office just 1 month. So earlier this week, the president signed the American Recovery and Reinvestment Act of 2009. That act consisted of an expenditure of $789 billion, down considerably from what was first proposed by the House of Representatives and even later by the Senate. Its major components were $288 billion for tax relief, $144 billion for state and local fiscal relief, $81 billion for protecting the vulnerable, as it was called, $111 billion for infrastructure and science, $53 billion for education and training, $59 billion for health care, and a mere $8 million for the category Other. So today we're very fortunate to have with us three distinguished economists. In the center, Michael Salinger, Professor of Economics and Everett W. Lord Distinguished Faculty Scholar in the School of Management. Professor Salinger is also the former head of the Economics Division of the Federal Trade Commission. On my immediate left, David Weil, Professor of Economics and Everett J. Lord Distinguished Faculty Scholar in the School of Management. Professor Weld is also co-director of the Research Fellow of Transparency Policy Project at the Tubman Center at the John F. Kennedy School of Government at Harvard University. And to my far left, Simon Gilchrist, Associate Professor of Economics in the College of Arts and Sciences here at this Boston University. Thank each of you for your willingness to participate in this panel. And for you in the audience, we will save some time at the end of this discussion for you to ask questions. And I will ask you when it comes to that time, and we'll remind you then that you need to come to one of the two microphones located in the aisle so that we can hear what you're saying. So I'm going to start by asking a really broad question. Was it really necessary for the government to allocate $789 billion for this recovery? And I'll turn to Professor Salinger to start us off.
It was absolutely necessary. One thing that we learned from the Great Depression was that, and from many other macroeconomic incidents, that sometimes market economies reach a point where they will not self-correct. For decades now, we thought that that was long behind us, that we would never see an incident like that again, and we wouldn't have to do the sorts of things that brought us out of the Great Depression. But this is a crisis that could be of that magnitude if we let it. And what we learned from the Great Depression was that what pulled us out of it was not the New Deal, which wasn't nearly big enough, but World War II, which was big enough. And so we need something of that kind of magnitude in terms of expenditure to pull us out of this crisis.
Professor Weil?
I totally agree with what Michael just said, and I think I would just elaborate sort of at the micro level. I mean, we've lost 3.8 million jobs since January 2008, and at industry after industry is in various states of free fall. I was struck yesterday by the report that new construction of homes had fallen to 460,000 in 2008, which was down, I think, from a peak of 1.2 million just a few years before that. And so the necessity of intervention on the private side, and also not only at the federal level, but in terms of assisting basically every state in the union that is in fiscal crisis now, I think couldn't be greater. And so the stimulus bill was absolutely essential.
Professor Gilchrist?
So I'd also agree it was necessary. There are a lot of economists out there who would argue it was probably not big enough. 800 billion. Paul Krugman would suggest 1.5 trillion. One thing to keep in mind, we've had since 1980 3 major recessions. 1980-82 recession was arguably driven by monetary policy, sharp hike in interest rates, which put the economy into a tailspin, purposefully to reduce inflation. The 1990-91 recession was a relatively mild recession caused by a variety of factors, but a loss of consumer confidence and consumer spending. And then the recession that followed the dot-com boom and bust. All of those things were mild and had what I would argue is relatively quick corrective market mechanisms to bring us back to stability. And what distinguishes this recession is it's driven by declines in asset values, which are impairing the balance sheets of both banks and the financial sector, and also households. And these declines in asset values mean that lenders won't lend and borrowers can't borrow, and this creates a self-perpetuating cycle, which is very different than the last 3 recessions that we've experienced. And so it's that self-perpetuating cycle which we'd like to correct by having a massive government injection of funds. And I think that is probably the biggest concern above and beyond unemployment considerations and things like that, is that absent some sort of stimulus, we won't bring us out of the spiral.
Well, Professor Gilchrist answered the question similarly to our other 2 panelists, but he also said something else, and I want to get their opinion. You also said it was not enough. At least I think I heard you say that, or it should have been 1.5. So I'd want to ask Professor Salinger and Professor Wild, was it the right amount?
Yeah, I think it was too little. And there's, I think, remarkable agreement in the economics profession that it's too little, which is probably a surprise to most people because, of course, the newspapers like to get disagreement on the op-ed pages. So you can find the op-ed pieces saying that this is all a big mistake. But the way most economists think about this is straight out of the introductory macro textbooks. There are a couple basic principles out there. You want to look at the difference between the unemployment rate and what you think full employment is. So the projections are that unemployment is going to be 9% soon, and we think of full employment as being about 4%. So there's a 5% gap. And then there's this thing, for those of you who have taken macro, this thing called Okun's Law, which says that you take that 5% gap and you multiply it by a number like 1.8, and that tells you the shortfall between the GDP and the capacity of the economy. And so you need to boost aggregate demand by about 9% of GDP. And then the other thing you have to take account is something called the multiplier, which everyone used to know what it was, and now very few people seem to know. I mean, when I say everyone, macroeconomists used to spend a lot of time calculating it, and as far as I can tell, they spend much less time calculating it. But the number you hear is 1.5. So you need a stimulus of about 6% of GDP per year. So take 6% times the 1.4 trillion, and that gets you, it sounds like, about the size of the stimulus. But this stimulus is not 1 year. It's in principle over 2 years, but actually a lot of the spending is going to occur after 2 years. So if you take this package by itself, it seems to be too small relative to basic macro principles.
Professor Well?
Yeah, I would agree that, and I think there is an amazing consensus among economists about the fact that it was needed and that it is probably too small and maybe on an order of, it needs to be twice the size that it came in at. But that being said, I think you also have to look at the question of political viability. And to me, it's actually remarkable how close the size of the stimulus is to what President Obama originally aspired and laid out when he originally kind of set out the target to Congress. You know, all of these kinds of questions are ultimately debated out in terms of Congress and ultimately in terms of what the public is willing to do at a point in time. The administration has been, even before President Obama took office, trying to lay out a story about the magnitude of this crisis, because I think we're talking about expenditures at a level our generation, the generation before us, has not seen. And so I think there's a political side to this question that puts a limit on the size of any specific stimulus bill. And I would only add to that, I thought it was interesting yesterday, or the day before yesterday in Denver, when the president clearly indicated this might not be the last stimulus bill to come to Congress in the next 4 years.
Well, it is remarkable. It sort of belies the consensus. It sort of belies the old joke, if you laid all of the economists in the world end to end, they still wouldn't reach a conclusion. Mm-hmm. Right? So it's remarkable. But I think that's an important point, because for we lay people who sort of pay attention to the press or the web or whatever it is to get a view about what's happening, you'd think there was no consensus anywhere about this stuff. So I think that's quite important. So it's too little. Dare I ask the next question, is it too late?
I certainly don't think it's too late. I think something needs to be done, and so better late than never. I think there's a question about what types of fiscal stimuluses we're enacting and what the speed at which those influence the economy are. And so infrastructure spending is a large part of the bill, but those are projects that are somewhat slow to get off the ground unless they're, quote, already shovel-ready and things like that. So I think the real question now is not, is it too late, but how fast will the economy respond to the various components of the stimulus package?
Well, so if I could ask Professor Wild and Professor Salinger to pick up on that. So with your knowledge of the way this recovery plan has been proposed, is it going to get into the economy quickly enough?
Well, the Congressional Budget Office estimates that 75% of the of the stimulus money is going to reach the economy in the next 18 months. I think that rests on a few heroic assumptions that I guess would cause some concern to me, and that is, again, we have never appropriated this amount of money at the federal level or from the federal through the state and local level. So it's it sounds strange, but it's an unprecedented problem to actually spend this much money that quickly. And one example of that is the discretionary account of the entire Department of Education historically is around $48 billion. And most of that money, discretionary, one should put in quotation marks, a lot of that money has all kinds of specific ties from Congress about how it can be used and in what form. The stimulus bill has $50 billion additional dollars that the Secretary of Education basically has to figure out how to spend with very few strings attached. So you have that kind of problem of how do you set priorities and how do you get that money out quickly and effectively. And so the assumption is that's going to, on paper, go out in the next 18 months. But then there's also the fact that much of this money has to work its way through state-level structures. The infrastructure money will ultimately be bid out through state kinds of infrastructure projects and methods of allotting that money. So I think one of the questions to me is, even before you start getting the ripple effects and the multiplier effects of this money, is the challenges of just getting it out at this first level in any of these projects.
Mr. Salinger?
Well, I don't pretend to have mastered the details of what they're going to spend the money on, so it's a little hard to say. But what I found puzzling in the process was, as they were trying to get at least a couple Republicans to buy on to the package so that you get a vote in the Senate. What the three Republican senators who bought onto it seemed to lobby for was a reduction in the aid to state and local government. And that struck me as being completely mystifying, because it seemed to me that if you wanted to figure out, well, what would be spent pretty quickly, this was going to be, you could spend that immediately to just avoid layoffs of policemen and firemen and school teachers and so on. So it would get in immediately. And then one thing you want to ask about these expenditures is, is this expenditure for things that we think are the proper role of government or things that we don't think are the proper role of government? And that all would have been money spent on things that we've already decided are the proper role of government. So why they chose to try to pare down what was probably the most persuasive part of the stimulus, I just don't understand.
Okay, so it may not be too late, but there are going to be some challenges actually getting this distributed and getting it actually spent. I'd like to turn the attention a little bit to a controversy that seemed to happen as the bill was being put together. That is the split between the effectiveness of spending and tax cuts as stimulus activity. And it turns out that the tax cuts, or tax cuts would not be even the fair way to talk about it, but tax relief wound up to be about a third of the final package. So why the debate about spending or tax relief? Doesn't a dollar get in the hands of somebody who spends it and a dollar's a dollar, or is there something we're missing here? I don't know which of you would like to start that, but.
I defer to the macroeconomist to start.
Okay, so there's a distinction between spending and a tax cut. The spending, if it's done by the government, automatically raises GDP by at least the amount of the spending. If it's a tax cut, there's no guarantee that the consumers or the firms that receive the tax benefit will necessarily spend the money. And given the rise in household savings that we've seen going from 0 to 3% in the last 3 months, it's a fair question to ask, if we give tax relief, how much of that on the household side will be spent. So there's that issue. The other issue is to what extent these are actually cuts in tax rates on marginal activities versus simply effectively transfers to the households which don't affect costs of activity at the margin. And so the payroll tax both boosts a reduction in the payroll tax both boosts household income, but it also reduces at the margin the cost of hiring workers to firms. And if you're worried about unemployment, reducing the marginal cost of hiring workers sounds like a very good idea. But it might still be the case that in terms of the wealth effect on the consumer, that impact isn't very big because they are increasing their savings in proportion. So,
Well, right. So I've always been puzzled about this, because part of the story you hear is that the expenditure multiplier is bigger than the tax cut multiplier, which is driven by the marginal propensity to save, which is near zero in the U.S. So, I've never, yeah.
but rising rapidly.
Rising rapidly from 0 to 3%, and on top of that, it's true that when we do $1 of government expenditure, we count it as $1 of GDP. On the other hand, even if you count it as $1 of GDP, if you get something that's completely worthless out of it, then it's not really clear that it's fair to count it as $1 of GDP. If sort of the proverbial, I hire someone to dig a ditch and then I hire someone else to fill it back in. We can call that GDP if we want, but probably if the money were in people's hands, they would have gotten something better out of it.
Right, so Keynes had this quip, why should we worry about the amount of spending? We should just, take bottles full of dollars and bury them in the ground and let people dig them up, right? And that would stimulate the economy. So, this relates to sort of how consumers react or how households react to cuts in taxes today versus what they expect their future burden is in terms of how they repay it, right? And it also then relates to the size of the multiplier. And so, although this is standard Keynesian economics in some sense, when I taught, macro 102, we would teach that the multiplier was on the order of 5, which was 1 over 1 minus the marginal propensity to consume. Now, no one thinks the multiplier is anywhere near that big. And why don't they think it's anywhere near that big? Because there's a lot of offsetting behavior in terms of how households respond in terms of tax cuts today versus expectations of the future, right? And so that's part of the story. And so I think it's a complicated question to answer, right? Exactly what the multiplier is, exactly how households will react to cuts in taxes versus increases in spending. And it's even more complicated by the fact that the current estimates of what this multiplier is are based on completely different times. They're based on the military buildups that we've experienced over the last 50 years and what the estimated impact of large-scale military buildups are on the economy, which generally have occurred during normal economic times, right? And so when we say the multiplier is 1.5, I think we could put standard errors around that and be anywhere between 0.8 and 3, right? And so so one of the arguments for why we actually might want a very big stimulus is that we really don't have very good ideas to what the actual multiplier is, especially in times like these. So,
yeah, I was going to say, and just adding to what Simon was just describing. I mean, I think the question of tax cuts versus expenditures is also context specific, and I certainly don't know, and I think a lot of people at this point don't exactly understand how the economy works at this moment in time because it's an unprecedented period. So we have, the analogy that sort of strikes me, I've heard someone describe, it's like you have a bunch of people standing around the swimming pool and everyone's worried that the pool is very cold and no one wants to be the first one to jump in. And so everyone's looking at some other poor fool to jump in first to see if they freeze to death or if the water is reasonable, and after that the others will jump in. So I think, to me, the practical question on either thinking about tax cuts or expenditures is which of these activities creates and just changes the overall set of expectations by both businesses and consumers about where we are, and therefore the incentives on on the part of businesses to expand, to borrow, to think about, instead of shrinking employment, once again, growing employment. And similarly, where consumers are at in terms of their expectations about whether they just got to keep holding tight or whether the situation's really changing. And that's where I think, again, we're in such an unprecedented moment. That's a difficult thing. And I guess in that context, why sort of appealing to expenditures in the way, Michael, you were talking about a bit ago, around things that we know, activities that we've committed to but might not be able to undertake at this moment in time, absent, help to states to do things like hiring police and making schools as sure as schools stay open.
Well, let me ask this then. So it was a large expenditure, and of course it's on top of an almost $700 billion expenditure that was made on TARP, so it's about $1.4 billion. And the consensus is that it should have been larger. But it is correct that this stimulus package on the TARP previously adds massively to the country's debt. So what happens if we need more? Are we sort of at our debt limit? I mean, can we keep doing this and as long as we want? If we need another couple of $1 trillion, no problem, just crank up the presses? Professor Gilchrist?
Okay, so why might we need more, and where would we get it from? So there's two reasons we might need more. One is that the stimulus isn't large enough in the way we've talked about. The other is that we have this massive hole in our banking system, and we need to fill that somehow. And that's the so-called Geithner plan, which no one quite knows what that will entail yet, except that it did entail a statement that they expected somewhere on the order of $2 trillion to ultimately recapitalize the banking system. And so if we add $2 trillion to 1.5 trillion or another $2 trillion from the fiscal side, whatever it is, that's a lot of money. So where do we get that from? Well, the government borrows it partly from abroad, but also partly or mostly at the margin from the increase in household savings that we're currently seeing. The net result of that is a very large increase in the debt to GDP ratio of the United States, but large by post-war standards, but certainly not large historically. And that's the thing to keep in mind, that in World War II, our debt to GDP ratio was, I think, 120%. Right now, I think our debt to GDP ratio is 45%. And the worst case scenarios, I think, would push it up to 75 to 80%. That's a very large number, but it's certainly a manageable number by the standards of developed economies in the post-World War period. And so, I think it's feasible, and I think we're ultimately going to see a very large rise in our debt to GDP ratio. And I think we're then going to have a serious conversation about what we do in terms of future taxes versus future entitlements, and to bring that back down over time.
So we just issue more debt, and we try to find buyers of it, and if we couldn't find external buyers, the Fed would just buy it.
Well, the Fed buying is the same as issuing more debt, right? So that's really not part of the equation in that sense, right? The Fed buying it is the Fed using its balance sheet to purchase assets, and ultimately it will resell some of those assets and recover some of that money, but to the extent that it takes losses, it will have to pay for those losses either through capital injections from the Treasury to the Fed, or through a reduction in profits that the Fed makes that are then rebated back to the Treasury. So ultimately it's debt of the US taxpayer, and that's financed either by the increase in household savings that we're seeing in the United States or by borrowing from abroad.
Professor Salinger?
Well, I was going to say that the short answer to your question is yes, we'll just borrow it. But in terms of the things that the money, there's one question which is, what if you need more fiscal stimulus? And then there's another question of, what should we do about the banks? And I said I thought there was a consensus among economists about the fiscal stimulus. I think there's a similar consensus among economists about the banks, which is they don't really know what to do about the banks. So the things to worry about is that piece of it. This is, people say that that the reason Japan had their lost decade was because they didn't solve the bank problem, and that what Sweden did right was that they did solve their bank problem, but that was a much smaller problem than doing it in the U.S. economy. So I'm not giving you the answer you would like, but I don't think anyone has it.
David, do you want to comment on it?
Well, only to say, I mean, I think that the issue where there is some agreement is not in the diagnosis of what should be done for the banks, and I agree. I think that I mean, we've already seen. I think we're now on the fifth kind of iteration. We're going back to the initial, or at least some of the discussions going back to the initial view about what should be done with the banks. But I think where there is an agreement is that the policies towards the capital markets are interlocking and necessary counterparts to what happens on the stimulus side. So, the stimulus fix is not the fix in and of itself. You still have the problem of credit markets that are largely still frozen, and so until you deal with that other problem at the same time as adjusting to this.
Well, let's pick that up for a minute, because I think it would be fair to say that when the Treasury Secretary announced what the plan, that it was either not well understood or met with some lack of enthusiasm. What could he have said, or should he have said, that it would added more clarity to or purpose to his plan?
Geithner or Paulson?
Geithner. No, the current.
I was going to start by going back to Paulson.
Please do.
Because I think it's important in terms of, there's a lot of discussion that Geithner came out of the box too early, and that he should have waited before there was a more developed plan. But I think that's speaking to a problem that was created originally when Secretary Paulson announced the first approach to the banks, and that was, at least in my mind, there was a level of certainty in the diagnosis in some of the initial pronouncements that turned out not to be correct. That the reality is we knew much less where we were and what the solution was at that point in time than at least Secretary Paulson implied, I think, in some of his opening comments. And in fact, the backlash from Congress when he appeared and said, I thought, when he came to Congress and said, well, things changed, I didn't spend it the way I said I was because the situation turned out to be very different. That wasn't, to me, an implausible statement. The problem was the expectations that were created a month or two before, when he originally kind of set out this very clear view about relieving the toxic assets, and that would sort of make everything move forward. So I think there has been a lot of talk by this administration about the importance of transparency and being clear about both what the reasons for different interventions are and then the steps that are taken under that. And I just think that has risen in importance at each new chapter of this crisis. And I think some of the negative reaction to Geithner was in fact still a residue of the way we originally entered into this whole problem, and because there was, in a sense, a lack of candor about what we knew and what we didn't know, and how we would need to adjust going forward based on actual experience.
Michael or Simon?
Well, they could nationalize the banks, and which would be, I mean, and the idea wouldn't be to to have the government running them for very long. It would really be a kind of bankruptcy proceeding, and you'd wipe out the shareholders, which the shareholders wouldn't like much. But then the creditors to the bank would become the equity holders in it, and you would have, and then you would have adequate capital in the banks, at least as I understand it. So it would be politically, it would be a very unpopular thing to do. And even if it's clean conceptually, I'm sure that there are probably practical reasons why they're nervous to do it, but I'd be interested. How bad an idea would that be?
So I've actually thought about this some. If you think about the bank's liability side, who the claimants are, you have equity holders, you have bond holders, you have depositors, and then somewhere in the background you have taxpayers. Okay? On their asset side, you have things like loans, and then these other assets, such as mortgage-backed securities that they've purchased. Now, we know that the mortgage-backed securities have lost tremendous value. There's no reason to think that those valuations are going to recover in some scheme of a bad bank setting prices and things like that. There's no reason to think that housing prices are going to come up to some level of 2 years ago. So there's a big hole on the asset side in terms of losses. If you look at the effect of the economy going forward, the loans outstanding of the banking system and the shadow banking system, the expected losses are huge. If you looked at Citibank and Bank of America, I don't think there's any way that you could seriously argue they're not completely insolvent right now. In fact, it's probably true that the top 10 banks in the United States are all insolvent if you marked assets to market. Now, bankruptcy is a complicated process and takes years to work out among competing claimants. And so one argument for why nationalization isn't feasible is that it would require a taking of assets of some form or another by the federal government. And so, you know, one view is that they've tried to organize bank bailouts in such a way that they're essentially voluntarily adopted systems by the claimants, the competing claimants. It's easy to wipe out equity holders, and everybody understands that that can be done. In fact, the market capitalization of the banking system, the top 6 banks, is only $170 billion, I think. And that simply reflects the fact that they expect to be bailed out by the government, I think. The bigger question, so those guys could easily get wiped out through any sort of scheme of recapitalization of banks. The bigger question is, why don't we go after the bondholders? And that's, in fact, a complete mystery, as far as I can tell. There seems to be an implicit US policy that we bail out bondholders of banks. This goes back to the Brady bonds and the Mexican crisis and things like that. So we could actually have an expedited bankruptcy process. We could have enacted it in the last 3 months and then use that process to close down banks quickly, to reorganize claims, to wipe out not only equity holders and bondholders, and then after you've done that, see what's left over and what types of capital injections the government would need to infuse into the banks, holding claims on the banks in terms of their equity, either preferred or common. And they're going to do some form of that, but I strongly suspect the order of claimants is not going to be as one would think it should be in normal bankruptcy, which is equity holders, bondholders. Depositors, everybody agrees, should basically be guaranteed, and that's fine. And they will be. And then lastly, taxpayers. The ordering is within the US government's policy, equity holders, taxpayers, and then bondholders. And I think ideally there should have been a deep discussion when Geithner proposed this plan as to why that's the appropriate ordering and why, if anything is done to the banks, that we bail people out in that order. And I don't think we've gotten a straight answer from the administration as to why that's a beneficial policy for the US economy as a whole to bail out bank bondholders. So.
And in fact, if I understand, if we wiped out the equity holders by some nationalization scheme, essentially the bondholders would now be backed by the federal government.
I think any scheme that's being considered currently by the administration is giving guarantees to the bondholders. I haven't heard of a scheme that would not do that, that they've openly considered. And in fact, what I have heard is that discussion among Treasury officials and other people, that those schemes tend to be rejected.
So are we allowed to ask questions to each other?
Sure.
I'm just
Just can't ask questions of me. You can,
Oh, is that right? Okay.
That's the
Then
rule.
I'll do that next. No, I was just wondering, it's sort of a subtext of what you just said, Simon, is that, in a sense, this isn't as much of a problem of valuing the toxic assets, as they're called, as opposed to just coming to grips with the fact that these major banks are insolvent and then taking the necessary steps. And the fact that it seems to me no one is willing to say that at this point in time. And so the discussion is kind of hidden behind this thing about, well, we'll remove those and then we can kind of take the next steps.
I think that's right. I think, if this was a single bank that was insolvent, regulators would go in. They would mark assets down to market. And then they would look at what the claimants are. They would wipe out the equity claimants. Some of the bond claims would be reduced. And then they would put in capital injections, right? And now it's quite clear that the banks themselves won't sell these assets at market prices. I don't think it's because we can't establish market prices. I think it's because if they do, then they are legally
They're
insolvent,
insolvent.
right? But I think it's not so much a problem of marking down assets to market and selling them and establishing prices as it is the unwillingness to just come out and say the banking system is insolvent and it's going to cost $2 trillion to fix it, right? So.
Michael? Yeah, okay. Well, let me change the subject slightly, but not that far. It seems quite likely that in addition to these expenditures, which if I'm listening to my colleagues here, we haven't seen the last of this anyway. You cut it, it's just going to take more money. But it seems also clear to me that given what we've seen in the financial sector and other parts of the economy, that after we've kind of cleared the air a little bit here, there's going to be a movement for more government regulation. So if you agree with that, what kind of regulation do you foresee in the future? And if you don't, why don't you agree with it? So Professor Salinger, I'll start with you.
Well, we're certainly going to see more regulation whenever there's a crisis like this. There's an imperative to do something, and the challenge is going to be do something that helps as opposed to doing something that hurts. I think it's likely that we're going to see some sort of capital adequacy requirements for types of financial institutions that haven't had those before. And it'll be interesting to see what happens with regulation of the sort of complicated assets that seem to have gotten us into the problem. So there was this very clever idea of, initially apparently clever idea of taking these mortgages and putting them in pools and creating these tranches so that you could create so that there would in principle be a pretty safe tranche because you just get the first money coming in. And so I think that sort of the big question is, was that inherently a good idea? And we just misestimated what the risk was, but that now that we see what the risk is, we should continue to do that. But things will be priced more appropriately, or are we going to regulate these things out of existence? And they have created a real problem, because if you think about what do you have to do to fix or ameliorate the housing crisis, you have all these mortgages that need to be renegotiated. And if you had sort of a traditional mortgage where you had the borrower, and then there was a bank down the street that owned the mortgage, then the borrower would go down and meet with the loan officer, and the loan officer would try to figure out what they could get, and they'd rewrite it. But now you have these mortgages where the ownership of the cash flows is so complex that it's not really clear, as far as I can tell, who has the authority to renegotiate these loans. So my guess is we'll see some sort of regulation that will try to make, to try to get rid of that problem.
Well, just let me go a quick thought. I understand what you just said about the complexity of ownership, but when it comes to foreclosing, it seems like it can happen pretty quickly. So somebody seems to know who owns what.
Right. The foreclosing can happen really quickly. The question is, if you want to avoid the foreclosure,
Who do you talk to?
Who has the authority to say, okay, we'll take 80% of what you had previously promised?
Who has the authority? Who's the authority that says let's foreclose?
No, who has the authority to say, well, we're not going to foreclose, we're going to
But I'm asking. I understand that, but I'm asking, why is there an asymmetry between who can say we will foreclose and who can't renegotiate or figure out a renegotiation plan? Do you understand?
Yeah, no, I understand. So I think to agree on a different stream of payments, there would have to be agreement from more parties than you need agreement for on the decision to foreclose.
So, all right. Simon, do you want to chime in on the regulatory or this last remark?
Yeah, well, I totally agree with Mike that this originate-to-lend model and then the diffuse investors that you get with that create a number of problems in terms of the moral hazard of monitoring loans, who bears that burden, on up to in default states or renegotiation states, can you actually get parties to sit at the table and renegotiate? Foreclosure is in the contract, so that's the easy out, right? Mm-hmm. So renegotiation is not in the contract, and you can't write a contract that, in some sense allows for that type of renegotiation that's needed. So there's just an inherent asymmetry in what we can contract on, I think. I think there's, and I completely agree with Mike that we're going to see regulation of not just the banking system, but the shadow banking system, investment banks and things like that. There's no way that we're going to see leverage ratios of 30 to 1 on institutions which act like banks. And keep in mind what it means to act like a bank. A bank is an institution which essentially borrows short and uses that money to invest in assets that are long-term. And the reason they do that is because the long-term assets, the value of these assets are generally opaque in nature and only known to the bankers themselves. And so the system as a whole designs itself such that the short-term borrowing is like a discipline device. Such that if I worry about what this banker is doing with my money, I can pull my money out. Now, short-term is either deposits, which are now guaranteed, or it's money market mutual funds and other types of funds which flow into the banking system. But the nature of banking, because of this transformation of maturity, means that banks are essentially vulnerable to bank runs. Whether or not we call them banks as in Citibank, or there are other institutions such as Bear Stearns, which are investment banks, they're all doing this maturity transformation and investing in assets which are opaque in nature and therefore subject to bank runs in some form or another. And that's what we've seen, is that not just the banks face bank runs, but these shadow banks also face bank runs. And so we need to solve that problem, and the only way to solve that problem is in some sense to require capital ratios for any financial institution which engages in this activity of maturity transformation alongside investment in assets of unknown quality. So, so I think that's just going to happen going forward. There are a lot of other issues associated with the details of regulating banks. Rating agencies have fallen down on the job in a completely predictable fashion in the following sense, that once we enacted Basel II, which was a new form of valuing bank capital for regulatory purposes, that gave a primary role to rating agencies and the ratings of assets in terms of valuing capital. And once those rating agencies had that primary role, then they had an incentive to rate stuff highly, which was of lower quality than it truly was. And so we got a complete distortion of the rating system. And so one could argue that we should not in any way rely on private rating agencies in terms of valuing capital for the purpose of capital adequacy requirements. So I think that's something that has to be thought about. There's a third aspect to this financial crisis, which has been underplayed recently, but clearly caused major issues during the liquidity crunch in the fall, and that's the credit default swap market and other markets like that. Those are insurance markets. People write contracts to provide insurance, and we allowed financial players to write contracts to provide insurance where they didn't have to show any capital reserves against losses due to default claims. That's an astonishing way to organize an insurance industry, and we don't actually organize formal insurance industries that way. But somehow when it came to financial insurance contracts, we let this happen. And that has to be changed too. And then finally, a lot of these things like credit default swaps and these other exotic instruments, they're complicated in part because they're traded over the counter, not through formal exchanges. When in fact, there's probably no real good reason why most of these contracts can't simply be traded on formal exchanges. Once they're traded on formal exchanges, then we can use market prices to value them and then assess the risks properly in terms of capital adequacy requirements. So I think those are key areas that we need to rethink.
David, did you want to comment?
Yeah, I always like to talk about regulations, so as my students in the room are well aware. I would pick up on some of the themes that Simon just was raising and maybe put it in a bit of a different way. I think there are three areas where we're going to see action. One is transparency, and transparency is this thing that everyone loves to invoke, and it's like motherhood and sunshine. It can mean anything to whoever's saying it, and it's almost reflexive out of both people in the administration and Congress. But there is an important element of transparency that I think is going to come out of this crisis, and that is certainly in the financial markets, in the banking sector, in insurance, all of these areas where there was just an opacity about the investments that people were making or the nature of the investments that I think Congress and the White House is going to come back to and say we need a better system of disclosure to deal with that. I say that knowing the fact that the history of financial disclosure in this country has been very uneven, very episodic, just prone towards sort of an ongoing cat and mouse game of having new disclosure policies and people figuring out new ways to kind of move around them. But I think over time it's an inevitable feature that we'll need to see more of. And I think transparency is something we're going to see in a lot of other areas, including the disclosure about the stimulus bill. I think the public wants to know where this money is going and how it's being used. I think we're afforded now with information technologies an ability to do that better. But again, I say that knowing there are pretty clear problems of any transparency system particularly disclosures gaming them and figuring out ways to deal with it. But I would cite that number one. The second, and Simon mentioned several examples of this, the crisis revealed a number of really bad principal agent problems we had in the rating agencies and the way those rating agencies had sort of dual loyalties, and therefore things were being given the highest rating that clearly were not. The subprime mortgage fiasco is in part just a story of a colossal principal agent problem, particularly around, we were talking more about the back end and the investment side, but clearly in the front end and the role of mortgage brokers giving mortgages to a lot of people with no incentive to actually look at their ability to repay. So I think, and I think this is a crucial part of some of the transparency discussions regarding the mortgage market, have to be wedded to dealing with some of these principal agent issues that this crisis revealed. And the third area, just to spice life up a little bit here, is there's clearly, I think, going to be a congressional and administration effort looking at executive compensation. I think the anger and awareness of how much the income distribution in this country has gone awry in the last 10 years, and whether people rightly or wrongly ascribe some of the problems to the last period to that, I think is going to put out there a real call to have different methods or dealing with the ratio of what executives make relative to the median worker in companies or in the economy as a whole. And again, I say that knowing the problems of executive compensation. Economists there are forests cut down with papers on the impact of executive compensation plans and some of the unintended consequences of them. But I see it as politically inevitable that some version of that is going to come to Congress and the administration.
Thank you. Well, what began as a subprime mortgage problem or a bursting housing bubble problem has certainly escalated very quickly into a very serious global economic problem. Every sector of our economy and every economy around the world is suffering from this, and I appreciate all of the comments that were made by my colleagues here about this. I was going to ask an end question, which was going to be, well, when will the economy recover? But having listened to my colleagues, I know they would either throw something at me or laugh out loud. So I won't ask that question. Instead, I'll ask you if you have questions that you would like to ask the faculty. And if you do, what we need you to do is just come to a microphone, and we'll check to make sure they're on, and we'll take a few questions. So would you tell us who you are and then ask your question?
I'm Yoni Gontovnik. Is the microphone on? Is it on?
It appears to be.
I'm a senior in CAS. And question is, with financial markets crumbling, a lot of people being laid off, what do you think the trickle-down effects will be on the market for all of those workers who are moving away from finance and for people who would have initially gotten into finance that are going to move into different industries?
Good question.
Well, I think the financial sector is going to shrink. And the advice I give students is study accounting. I think that a lot of these Dean Lawson said what sort of regulations are going to come out. And I think there's going to be a big need for accountants and a big need for people who think about accounting issues in sophisticated ways. That a lot of the problems stem from accounting practices that didn't reflect economic reality. So that's my advice for, it's worth what I charged you for it.
David or Simon?
I won't give advice, and I don't want to be bleak. But I think one of
Appropriate as that might be.
As appropriate as, well, I mean, and I was going to say, and now I'm going to be bleak, but I think, clearly the expectations we all had about how careers would work and about earning potential and about employment security, I think, have fundamentally changed. And again, I don't think we know what they're going to look like, but I think the whole question of the careers going forward and people's expectations of them are going to change. I mean, it's almost glib to say people have for a long time been saying you need to make your skills portable, you need to be ready to have multiple employers in the course of your lifetime. And I think that's true. And it's always easy for tenured professors to talk about that's a good thing and you should be ready to move around. But I think one thing that is magnified and will be more true is that notion. I think there's just going to be a lot more instability going forward in the market, and that again, I think there are a lot of negative impacts of this, but that shifts a lot of the risk to individual workers, whether those are low-skilled workers or highly trained workers, about how they're going to have the capacities to move between what will be changing occupational and employment demands over the next 10 years as we slowly work our way out of that.
So I'm not a career advisor either. If you look at the financial services industry, it's grown phenomenally in the last 10 to 15 years, partly due to what macroeconomists will call technological innovation, but also partly probably due to some of the moral hazard issues that have resulted in incentive schemes and compensation schemes, which have led to large profits and large incomes for certain people working in those sectors relative to other outcomes. To the extent that technological innovation is going to, in the financial services industry, is going to be reduced, and to the extent that some of the incentive issues are changed, I think that's naturally going to lead to a shrinkage of the financial services industry. I think the broader point to keep in mind is that the U.S. economy has been phenomenally productive over the last 30 years relative to other economies in the world. And that productivity has come from technological change, which has largely rewarded skilled workers and educated workers. And I don't see anything about the current financial crisis that has changed the underlying productive potential of the U.S. economy in terms of generating new ideas and new technologies and creating new industries and creating jobs for people. And those jobs, I think, will continue to be based on skills and knowledge, and people with skills and knowledge will continue to be rewarded for them. So.
Hi, my name is Justin Fisher. I'm an undergrad here at BU. Thanks for your time, first of all. I'm curious, over the last 2 months, some of the best minds have gotten together and basically come up with this colossal plan. I think we can all agree on the size of it, just huge. I'm curious how much is done to, analyze the long-term negative externalities of it, 10, 30 years down the road. How can this affect, things like commodities, inflation, and stuff like that?
Can you, with respect to the
Well, I'm just saying,
stimulus, or
so much has been done to take care of the matter at hand right now, which is fine. But in the long term, can you guys share any just insight on how it can affect things?
Well, what the government borrows, it ultimately does have to pay back. So people who express concerns about the tax burden that we're putting on, well, when I say it, my children, but you. So that's true, and the hope is that as the economy grows, that then the effect on marginal tax rates will be modest, and we'll be able to pay it off at a time when we can afford it, and that's worth the price that you pay to avoid having massive unemployment and frankly a risk of social unrest. In terms of long-term consequences, I think people are way underestimating the risk of inflation. That as we run up these debts, that most of that debt is in nominal terms, and there's going to be an incentive to inflate the currency. And we've done this before, and not Ronald Reagan ran up huge deficits, and I thought then that people were underestimating the risk of inflation, and I was wrong. But this time I might be right. Are you worried about inflation?
So inflation, as Milton Friedman said, is everywhere and always a monetary phenomenon. And there's a question about to what extent the Federal Reserve can, in the future, commit itself to a low inflation policy. We have a fairly good system right now where the Federal Reserve is largely independent of the Treasury and the rest of the government. What's somewhat alarming to people who work in the Federal Reserve System right now is the ballooning of the Federal Reserve's balance sheet in order to purchase assets through the Term Asset Relief Facility, TALF, lending facility. In some sense threatens the independence of the Federal Reserve, right? It's making loans to the private sector in a way which is ungoverned and really antithetical to what we think of as a democratic society, at least in the long run. Now, the Federal Reserve is doing that, I think, very reluctantly in a very real sense. So they don't want to be involved in this business. And part of the reason they don't want to be involved in this business is because it does threaten their independence, especially should things go awry and they need to go to Congress or go to the Treasury to recapitalize their own balance sheet because of losses incurred. So there is a worst-case scenario in which the independence of the Federal Reserve is actually diminished. And in that scenario, I would be very, very worried about future inflation. I'm a bit of an optimist here, and I think that we've pretty much established the benefits of strong central bank independence. And we've also established the benefits of low inflation environments. And so I do think that in sort of 5 years out, we'll return to a low inflation environment. Mm-hmm. Now, ironically, what we're worried about now is not low inflation, but about high inflation, but deflation. And in some sense, it's the same problem. We'd like the Fed to be able to commit to an inflation rate of something like 2 to 3%. And if everybody believed that, then a deflation wouldn't be a fear, as neither would an inflation be. And in some sense, the current emphasis on the importance of the fiscal stimulus is precisely because the Federal Reserve's interest rate is now at 0. That's the nominal interest rate. Borrowers and lenders care about real interest rates. One way to guarantee the real interest rate is positive is if we can increase inflation expectations in the short run. So there's a trade-off between trying to guarantee that in the short run people actually believe that we will conduct a fairly standard monetary policy which will yield an inflation rate of 2 to 3%, as opposed to a deflationary policy that's foisted upon us. And, boosting expectations of inflation, but not boosting them so high that somehow we will get runaway inflation in the future. And I think that's a concern that, Federal Reserve policymakers are very, very acutely aware of in terms of how they conduct policy today and how they communicate their policies. So.
Thank you.
Hi, I'm Adam Korengold. I'm a fourth-year Pemba student going on fifth year. My question, I was quite surprised. I didn't hear any of the panelists mention the auto bailout. And my take on my observations of the economy of the last 15 years is we've had a very speculation-based economy. We had the internet bubble burst, and we had following that, we had a massive wave of money coming into this country that fueled the housing market. Now, is manufacturing dead? It seems like the country doesn't care about the automakers. The politicians don't care. Certainly Republicans don't care by trying to reject the bailout on General Motors and Chrysler. can we have an economy that's sustainable based on solely on services, or do we need to have a manufacturing component? And is that the future of what will turn this around, or is service the way to go? Or will we all be, is there a way that our entire economy can be service and we'll be buying cars from China and importing, or will manufacturing?
Okay. I think we get the question.
Okay.
Well, first of all, I guess I read the response to the auto industry somewhat different than you. I mean, I think there's a lot of concern about saving the industry. I think it springs from different views. I mean, I think there's some people who view this as a way to save and rebuild and move the auto industry, a leaner U.S. auto industry, forward. I think there are other people who, quite frankly, realized that if the auto industry was to sink suddenly, the implications and the ripple effects of that would have just short-term, very devastating impacts in and of themselves. So whether or not you actually believe the kinds of fixes that are going on right now will ultimately create this kind of lean, mean new U.S. auto industry, I think a lot of people have a much more short-term set of expectations on that. Our ability to kind of forecast what the economy of the future should be made up of in terms of sectors, I think, has never been very, very good. And so, in the longer run, how much more we shift away from manufacturing towards service-based industries, I think that certainly is the trend of any developing country, and I don't see why that won't continue and why you can't have continuing economic growth in the long run because of that. But again, I view the auto industry issue and the reason it's being taken so seriously in the short run, and I would argue appropriately so, is just because of the impacts and the very concentrated regional impacts that would arise if we let what remains of that industry disappear. And I don't even have a dog in the fight anymore because I drive a Saturn, and that's gone. So,
Michael?
Well, if Chrysler and GM go bankrupt, we will still have a domestic auto industry. It might not be domestically owned, but there are other companies producing cars in the United States. I would let Chrysler and GM go bankrupt, and it's the concern I have, and I think it's a general concern with the new administration and the new Congress about the potential damage that organized labor can do to manufacturing companies and have done to American manufacturing companies for a long time. These companies just are not competitive, and it's largely because of their labor contracts that they're not, and they need to go through a bankruptcy process where those contracts get renegotiated. And I know I've just thrown out a bunch of red meat to my colleague who wrote the seminal work on strategic planning for labor unions.
Well, David, you need to.
well, I think I have to respond to that a little bit. I mean, I think there's a lot of blame to go around in the trajectory of the American auto industry, including choices on product lines and very slow response to the inevitable energy and environmental crisis we're facing, and the slow introduction of energy-efficient cars, holding on to things like SUVs and pickups too long. I would certainly acknowledge that what we have in manufacturing, and have had really since the late 1980s, is a period of adjustment of our collective bargaining agreements that were born in an era of United States dominance in steel and auto and rubber, and allowed the negotiation of the contracts that are slowly having to be unwound to this day. But you know, and my reading of the record of the auto workers in the last 2 years is they have been doing a lot at essentially unwinding as much as they can. And still, I mean, there's the politics of a union, just as there are politics of Congress, and keeping people in leadership positions in those positions. So I would just add, and I think one of the interesting things that President Obama announced yesterday was the assignment of this fellow Ron Bloom to be the point person, because Ron Bloom is someone whose career has been actually, although he comes from a labor movement background, he has been instrumental in dealing with bankruptcies in the steel industry and doing very innovative kind of restructuring of those, and is known as someone who can be tough to both sides. So I think that was, to me, is a good sign about someone like Ron, who will come into a situation like this and make both parties sort of deal with the realities. But I would share the blame a little more than my friend Professor Salinger.
But even if you're right, and I'll concede that you're right, that there's plenty of blame to go around, that's not an argument for avoiding bankruptcy. That is, if the reason they're suffering is their poor product choices.
Right, right.
Then,
well, I guess the real question is, can you get essentially the same negotiations without declaring bankruptcy? I mean, one of the attractions of the argument for bankruptcy is you void your labor contracts then, and then everyone really has to go to step one. I think the reality is, in that circumstance actually doesn't look to me that different than where they are right now, just given the enormity of the crisis, the pressure all the parties are under to do, you know, already things that 2 years ago would have been unimaginable in terms of concessions.
Simon, do you want to
Yeah, I
add
just
to this?
would like to add, you know, we are bailing out an industry, which is the banking industry and the financial sector, and that raises the obvious question about what industries should and shouldn't be bailed out. And I tend to agree with Mike that bankruptcy for car industries is a good idea, but more generally, we need to distinguish between the banking sector, in which its activity is integral to the entire U.S. economy, and should it actually fail en masse, would completely devastate U.S. economy, versus a specific industry in manufacturing where, should it fail, would put a small dent in GDP, perhaps, but would quickly be swallowed up in terms of other activities, and arguably in the long run shouldn't really be part of the U.S. economy anyway, right? So you know, when we have these debates, though, we do need to keep in mind why we are considering bailing out specific industries and what the goal of that is. And I can see a very clear goal for the financial industry, and it's much less clear for other industries, especially manufacturing. So.
Let's get another question.
Slightly different note. I'm Kabir. I'm a senior here at SMG. On the career point, everyone seems to be suggesting to go straight to grad school, or
here.
or being an entrepreneurship student. We hear that this is the best time to start a new business, and the common reasoning that people give is because, oh, everything's cheaper now. It's initial starting up is a lot less costly. So what's your outtake on that? And also, what's the trickle down of the stimulus do you see on small businesses, on our consumer level, small business level? I mean, apart from banks and multinationals.
Right. Where are you getting your capital as an entrepreneur? I mean, that's the first thing that comes to mind. I mean, I think on one hand, I think the argument is right. In a recession like this, there are a lot of resources that are underutilized, and that obviously has price impacts. But the the underlying question comes back to the access to capital, which is, clearly very, and in entrepreneurial areas where you're dealing with higher levels of risk, where you have blue chip companies having difficulty securing financing, the problems of an entrepreneur are magnified because of the reticence to lend in this kind of environment. So I think you're raising a critical question. I mean, entrepreneurial activity has always been one of the engines of growth and employment in this country. And so until you get your hands around the capital crisis, at least in my view, and I haven't looked closely at sort of business starts in this period of time, but I suspect I know what they'd look like. That's a huge problem that also has to be dealt with as part of this larger set of interventions.
It is the case that your costs might be lower, but it might be just as difficult to secure a revenue stream in addition to getting the appropriate capital.
Hi, my name is Matt. I'm also a senior here at SMG, the undergraduate. Just had a quick question for everyone on the panel. Basically, how do you reconcile the desire of the federal government to increase personal spending through both tax credits and stimulus projects with the necessity of households to begin saving money again? As indicated earlier, it's up from 0% to 3% now in household savings, and people need to stop spending more than 6 times of what they're earning. So basically, how effective do you think this program will be in its entirety in getting the American people to spend versus save? Thank you.
Great question.
Well, I think you've got it right. So let's.
Well, in some sense, that's exactly what the fiscal stimulus is for. Given rising consumer saving rates, we need to offset that reduction in spending by something else, which is government spending. Economists call this the paradox of thrift, right? If everybody saves at once, then aggregate income falls and total savings falls. Now, the paradox of thrift works in some circumstances more than others as an explanation for various phenomenon. But we should think of this as the government spending is designed to offset this decline in private spending. Then we should also think about how we would want the economy to allocate spending going into the future. And here I think the positive message is that to the extent that the government spending is going to be on infrastructure and other types of investment goods, I think that's exactly what we would want in response to this type of a crisis, rather than encourage consumers to go out and buy more, HD TVs or what have you, right? So the reallocation from consumer goods to investment goods that hopefully to some extent will occur under the fiscal stimulus, I think is a very good thing for long-run growth for the U.S. economy. So,
Okay. Why don't we? I think this gentleman was here before you, so
Thanks.
please.
John Donovan, also senior here at SMG. Just some questions about, I guess, TARP 2 versus TARP 1. TARP 1 came out and tried to purchase these toxic assets and then decided to inject liquidity as opposed to purchase. And then banks, I guess, hoarded cash, to put it bluntly. Now TARP 2, although it's still confusing, seems as though the 3 parts are kind of designed to avoid this. The first $1 trillion, they're still going to have to figure out a way to price these toxic assets. So my first question is, do you think there's a way to come to a price agreement for what these assets should be worth? And my second question is, in terms of the goal is to increase lending. Do you think this has big consequences as far as creating protectionist economies where you've got banks that have their hands held behind their back and have to lend within that own economy as opposed to international?
Thank you. Well. I'm not so sure.
I'll pick up pieces of it, and then Simon can tell me where I'm wrong. So the protectionist piece is the easy piece. So plainly, there's a danger of it. We've seen we've seen it in the U.S. legislation. We've seen it in other parts of the world. Everyone seems to think that the protectionism that occurred at the Great Depression just exacerbated things. So, so yes, it's a problem. Can we avoid it? I don't know. On the TARP funds, when I said that economists really don't know what to do with the banks, I mean, part of it is they're not really quite sure the right way to use this money, and it seems to me that people are yelling at the banks for not lending more. And that seems to me to be a terrible mistake for a couple reasons. I mean, first of all, the way we got into the crisis was we were encouraging financial institutions to make loans that they shouldn't have been making. So this just seems like more of that. And the banks now are at a point where when you have companies that where the equity is near zero, the standard concern about companies like that is that they're going to take excessive risks, not that they're going to be too reluctant to take risks. So if the banks are reluctant to lend money out, then, despite being in this position where they have an incentive to throw the Hail Mary, I'd be reluctant to push them. And it may be that the reason they don't want to lend money out is because they're saying, look, we're in a recession and there aren't good loans to be made. So that's more of an answer about things to avoid rather than how to avoid doing it. But that's about as far as I can get on it.
I completely agree with Mike that this notion that banks should be out there lending is misguided in the following sense, that what we want banks to do is to recapitalize themselves. And once they recapitalize adequately, then they'll have the proper incentives to use that capital wisely and to make the right types of loans. Until they recapitalize, the banks are simply hoarding whatever cash that they get in order to try and boost capital ratios and avoid being deemed insolvent. That's completely the right strategy from the bank's point of view, and I think the right strategy from the point of view of what the U.S. government would like to see achieved. Banks were also criticized for using TARP money for buying other banks. But again, that seemed like a very good thing to me in the following sense, that you took a strong bank who bought a weak bank. Now, capital adequacy is a very nonlinear phenomenon, right? Having too much of it at the margin brings you nothing. But when you have too little of it at the margin, you get a lot. So getting a strong bank to merge with a weak bank, I can see lots of reasons why that could be beneficial and a reasonable use of TARP funds. So I don't think there was a very good discussion in the press and to the public about what exactly we hope to achieve through this TARP money, which is basically getting banks to be solvent again. And once they're solvent, then they have all the right incentives to behave properly. So,
I would just add, I mean, I actually asked my question to Simon because I'm still puzzled a bit about this pricing these toxic assets. I guess I've spent most of my academic career in a department that's half finance, and my finance colleagues have convinced me over the years about the ability to price lots of very complicated things. And while there's certainly elements of this that are new and different, it's increasingly seeming to me like a way to dodge some tougher kinds of questions or admitting some tougher kinds of realities about where the financial sector is, in terms of just saying it's ultimately about we got to find a way to price these things, as opposed to saying let's come to terms with where a financial sector is and what's needed to take it forward. And I think that goes back to what Simon just said about a kind of discussion about the capital markets that I don't think that we've really had in our public discourse so far.
let me just add. So you can think about TARP 1 or the original plan of TARP 1 as being sensible in the following environment. If you thought that there was a liquidity crisis in the financial system and that banks were being forced to dump assets at fire sale prices, and that effectively that was in some sense a bad equilibrium where prices were artificially low and stuck there. And the government, by putting money into that system, buying assets above what that market price was could reestablish a new equilibrium of what would be viewed as normal asset prices. You could, if that were true, you could simultaneously, recapitalize the banks by getting prices back up through this mechanism. That was the original discussion in the liquidity crisis. I don't know anybody today who seriously thinks that the problem is that these things are going to be sold at fire sale prices in such a way that some government injection of overpaying for assets would establish a new set of prices which would be closer to a good equilibrium. I think that notion is completely gone. And so now I think it is a notion of what is the actual market price and how do we get that to be established, right?
But it wouldn't be that hard to establish the market price.
I totally agree.
It's just,
Right.
so it just comes down to if they get valued, I mean, as you were saying before, if they get valued at that, then we have to admit that
Right.
that
But if
Citigroup.
they established a market price, wouldn't that sort of demonstrate the insolvency of them?
Yes,
Right.
yeah.
So that's I think that's, so how do you do that without creating this insolvency? Did you want to ask your question or not? Okay. Let's have one last question then. Better make it a good one.
I'll try. My name's James Tao, first year PIMBA student. During the panel discussion, you talked about the new regulatory structures in the banking industry going forward. I was just wondering what you see the notion too big to fail plays in that future. Would we still have these conglomerate banks where, if they were on the verge of bankruptcy, create these adverse consequences for the rest of the economy?
Well, I'll let them answer, but we might find out pretty quick.
Well, first of all, Citigroup looks like, whether or not we want to get rid of Citigroup, whether we would want to break it up as a regulatory matter, it might get broken up just because people decide that that was a really bad business model. I think one thing we've learned from this is that what's too big to fail is smaller than we used to think, right? Because we have the layman experience, and we didn't think they were too big to fail, and we wanted to convince the markets that the government would let a big institution fail to try to avoid the moral hazard problem, but we've seen the result of that. So the concept of too big to fail is going to be out there for relatively small institutions, I think.
To echo some of David's comments earlier, I think this is where transparency, to use that word again, does come in. That a lot of the issues surrounding the failure of Lehman or bailing out AIG were related to the fact that we didn't know what the interlinkages were between financial institutions across these competing financial claims. And the more transparent the system in that sense, hopefully, we'll have a better handle on what too big to fail does mean in that world. And, I think it's been a big frustration for bank regulators and other people in this environment is to understand the degree of interconnectedness. And there can be, I think, a lot done to establish what that interconnectedness is, and therefore exactly who is, in some sense, too big to fail, or what the risks of failure of one bank are for the system as a whole. So.
Well, I hope this was useful to you. I know I always learn a lot when I'm listening to my colleagues talk. As a reminder, we will have what essentially will be our fourth panel discussion sometime in early May. So we'll bring together another group of faculty to sort of ask the question, how's it going? Where do we go from here? What's next? So just stay tuned for that. Professor Gilchrist, Professor Salinger, Professor Weil, thank you very much.